This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
MacroVoices episode 447 was produced on September 26, 2024. I'm Eric Townsend. Eric Peters, CIO of both One River Asset Management and now also Coinbase Asset Management, returns as this week's feature interview guest. We'll hit all the usual macro suspects, from secular inflation to competitiveness of the U.S. versus Europe versus China, to the U.S. dollar to deglobalization, and much more.
And I'm Patrick Serezna with the Macro Scoreboard week over week as of the close of Wednesday, September 25th, 2024. The December S&P 500 futures up 174 basis points, trading at 57.79. The bull trend continues to all-time highs with this post-FOMC rally. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. That US dollar index down 1 basis points to 100.92. The November WTI crude oil contract down 27 basis points, trading to 69.69, turning lower. But will we see a retest of the lows? We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The November RBOB gasoline down 51 basis points, trading to 197. The December gold contract up 335 basis points, trading to 26.85. All-time new highs and a stone throw away from the 2,700 target. The copper prices up 442 basis points, trading at 449. Big turnaround on the China stimulus. Uranium up 157 basis points, trading at 80.75, showing some life, but can the bulls follow through? The U.S. 10-year Treasury yield up 8 basis points, trading at 378. And the key news to watch this week is the core PCE price index. And next week, we have the ISM manufacturing and services PMIs and the much anticipated U.S. jobs numbers. This week's feature interview guest is Eric Peters, CIO of One River Asset Management. Eric and Eric Peters discuss Fed policy, global economic tensions, digital assets, and more. Eric's interview with Eric Peters is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Eric Peters, CIO of One River Asset Management and also of Coinbase Asset Management. Eric, it's great to get you back on the show. Let's start by talking about the U.S. dollar. What's going on here in terms of Fed policy, big picture? It seems like everybody thought the Fed should not wait until this close to the election to start easing because that would create the appearance of them becoming political. Seems like they have crossed that Rubicon. They sure do appear political. What is happening? What should we expect, and where do you see things headed for the dollar from here?
Well, for starters, great to be back. It's been a while, actually. As we were chatting pre-game here, it's been a little while. But yeah, really nice to be back. Boy, the Fed being political I think the Fed is naturally political, given that the chairman is appointed. Question is, how removed are their decisions from the political calendar and process? And I think they've got a very difficult job here. They were well behind the curve for a long time. They had thought inflation would be transitory. They obviously changed that tune and raised rates at a pretty unprecedented pace relative to history. And now we're sitting here with quite high real rates. Prime rates are extraordinarily high on a real basis when you look back historically, which is where many businesses borrow. And I think that they've really been praying that we get lower inflation here and a bit of softness in inflation, just so they can try to bring that rate back down and hopefully create quote unquote a soft landing. I don't think it's extremely political. I think there are all sorts of other political manipulations that lead up to the election. The budget deficit this year has gone up, 25% roughly relative to last year coming into the election. So I think that's probably a more powerful force than what the Fed can do, just briefly before the election.
Eric, let's talk about the big picture of just the macro situation in the world between the U.S., the European Union, and China. We've got obviously new geopolitical tensions with China that are changing the relationship there. Where is this all headed?
I think we're starting to really see some of the reverberations from this new phase of deglobalization. Some people call it reglobalization at this stage, kind of just changing trade relationships. But however you term it, I think the world is beginning to look really quite different from a trade and kind of an economic zone perspective. And actually wrote a few weeks ago about just some of the vast divergences that are opening up. And I think, you see it happening economically, where China's economy is significantly weak. Their long-term interest rates have hit all-time lows. China's somewhat in a world of its own economically right now. Europe is really struggling. Europe is super stagnant. And I think what happened in Europe is Europe was built, and this is an exaggeration, but was built around the German economy, which was more or less organized to take cheap Russian gas and productize it in all sorts of different manufactured goods ways and then export those. And that model is in the process of more or less imploding. And then there's the U.S., which, the U.S., for all of our faults and, massive deficits and many things that inevitably are unsustainable. But for all of those things, the U.S. has outperformed dramatically. And so, some of the stats that I was looking at, which are kind of mind-boggling. I was just looking back from, say, the peak of 2007, just to pick a material market peak. In real terms, Euro stocks are down 30% from there. They're about unchanged on a nominal basis, but inflation adjusted, taking out dividends, are down 30%. They're down 50% from the 2000 highs. And if you look at that relative to the U.S. S&P 500 is up 60% from 2007 highs on a real basis, and up over 100% from 2000. So there's just been dramatic outperformance by both the economy, but also equity markets. And then it's almost laughable to look at those stats as they apply to China.
Going back to the U.S. dollar, I've long held the view that the reason that the dollar is the world's global reserve currency is simply that there is no viable alternative. And I've long argued that there are a lot of people around the world that are motivated to create such an alternative, hence the BRICS currency bloc and so forth. You're in a kind of interesting position because you're both a macro guy, but you also are having had the digital side of your business acquired by Coinbase. You're also very much in the digital currency business. So where do you see all of this ultimately being headed? Are we headed toward the dollar maintaining its role as reserve currency? If not, is it a digital currency that threatens the stranglehold or monopoly that the dollar has on reserve currency status? And if so, is that a CBDC, or does something like Bitcoin have a chance?
It's really interesting, Eric. Well, for starters, I don't think Bitcoin has a chance to, in the near future, the foreseeable future, let's say, just over the next 10 years, become a meaningful global currency. I think it's doing a wonderful job of becoming a decentralized, form of digital gold. And I think that there could be things built on top of the Bitcoin network that make it much more interesting and more valuable than simply gold. So I think Bitcoin is a very interesting story, but I don't see it unseating the dollar. What I do see is a really interesting opportunity that's opening up for digital currency. And I think that will take the form of, various forms of digital fiat. And currently the US dollar is the dominant digital fiat currency in the world. So, if you look at all of the private sector stablecoins, which is essentially a digital manifestation of a fiat currency, the dollar absolutely dominates that. But I think the Chinese are looking at this and saying there's a technological revolution happening here in crypto, and maybe we have a chance to export the RMB through these new digital rails. And anytime there's a technological revolution, you should expect volatility. And so I think some of the countries and economic blocs that would like to see the US dollar unseated, or at least see the US dollar be less dominant than it currently is, are trying to use this technological innovation to unseat the dollar. I actually think the U.S. was quite far behind a year ago. I think we're still behind from a regulatory standpoint, and yet I think that Washington, due to a lot of advocacy by players in this industry, has started to realize that actually, if the U.S. can provide some clarity around these technologies, it's possible that the U.S. dollar will be distributed globally in a tokenized form. So not necessarily a CBDC, but a private sector stablecoin is, I suspect, what will happen. And the US dollar could become that much more dominant in this new technological revolution. I think that's definitely in the US best interest. And I think that Washington is starting to see that. So I think it's probably pretty exciting for the dollar.
So let me just make sure I understand this. Your view is that the reason the dollar is likely to continue to have the monopoly that it's had for many years on reserve currency status is that it is about to be supplemented by a private label stablecoin, which won't compete with it, will just basically provide a linked mechanism, a tokenized mechanism that is tied directly to the value of the dollar. You think that the prevalence of that digital mechanism will actually prolong or potentially extend the life of the dollar as the world's global reserve currency?
I think if well executed, and well executed means the private sector and also the regulators, I think if well executed, that is very likely to be the case. I think there are other reasons for dollar dominance, which are all the obvious ones that have led to dollar dominance for such a long period of time. And those don't just disappear overnight. I don't see a great alternative to the dollar out there. And I don't think, practically speaking, cryptocurrency is going to take over the world anytime soon. But I think stablecoins probably will, and that's the opportunity for the dollar. So yes, I think that could be the case.
Eric, why do you think specifically that stable coins are going to play such an important role when other people might have argued that, in new tokens, whether it be Bitcoin or Ethereum or whatever, that are their own currency are where it's at? You're saying it's more likely to be stablecoin tokens that are tied to an existing fiat currency. Is that because of the prevalence or the recognition of the fiat currency, or is that for other reasons?
I think it's mostly through recognition of the fiat currencies and because governments will accept that. So, an issue that you have, for instance, just with Bitcoin, if you were to think about it as something that would take over the dollar on a global basis, your Bitcoin holdings are taxed. So if the price of Bitcoin goes up, if you own some Bitcoin and it goes up and you sell it, you have to pay taxes on that. And I think that creates all sorts of frictions just on a practical basis for the use of Bitcoin at scale to be used for payments. And what you observe with Bitcoin is it's not really used for payments. I mean, some people use it for payments, but it's really used more or less for a store of value at this stage. And I think there are all sorts of reasons for that, but one of them as well is just how it's treated from tax perspective. So I think you'll see countries around the world that have monetary regimes that are highly inflationary, where Bitcoin gets used, but probably dollar stablecoin as well. So depending on the preferences of the people in those currencies, they may use Bitcoin, they may use Ethereum, they may use any number of things. But I suspect you'll see wide scale adoption of dollar stablecoin. And by the way, once you have people adopt that, then they have crypto wallets, and they will probably turn to Bitcoin for some of the real store of value and even appreciation. So the adoption of stablecoins, I think, will be very positive for cryptocurrencies. Is a kind of a broad matter.
Okay, and you think that the reason that the stable coins will be adopted is because more actors in the conventional financial system will see the need for it, or what is the driver that gets us onto the stablecoin demand?
Yeah, they'll see the need for it. The ability to transact and move money around the world instantaneously at virtually no cost has been enabled by these technologies. And so throughout the long history of finance, it has been inevitable that when a new technology comes around that makes things faster, cheaper, more secure, they get adopted. And so there have been certainly regulatory headwinds that have slowed the adoption of this, but it is coming.
Let's go back to the inflation outlook globally and just talk about where all this is headed, because it seems like central bankers have been engaged in this round of policy that has felt to me like it's all about, thankfully that quick scare we had with inflation is over and behind us now. So let's shake it off, walk away from it, and be glad it's all over. I'm not so persuaded that it's all over. I think that we probably do have a persistent inflation problem. Would you agree? And do you think that central bankers are becoming too complacent about inflation?
I think that it's hard to call inflation a problem when it's a choice. I think the U.S. has made a choice, by and large, to debase the currency, kind of unburden ourselves from the debts that we're incurring through trying to boost nominal GDP as much as possible. And there are all sorts of ways of doing that. But I think that the U.S. has more or less made a choice that it wants higher inflation. That said, inflation clearly got out of control post-COVID and became a political issue. And so at the moment, inflation has been coming down, and politicians talk about how they think inflation's not a good thing. But if you look out at the fiscal plans of the U.S. right now, we're running a 7% deficit this year, with what appears to be pretty good growth. Certainly, that's what Powell had to say at the press conference. He's cutting rates to maintain what he says is a pretty good economy, or quite a good economy, but we're running a 7% deficit. If you look at the CBO projections for next year, it's 6.5. Then it goes down by 2027 to 5.5, and then it starts rising again. So by 2034, I think the CBO projections we're back to 6.9, 7% budget deficits. These are just mind-boggling numbers. So I think you've seen a political choice, and it's probably actually a reasonable choice for the U.S. to make at this stage. But we made a choice that, look, we've got a lot of people retiring. We've got a lot of baby boomers. We've got a lot of things to build. I think we got ourselves economically into a place where we felt very exposed to China and other trading partners, but perhaps adversaries, certainly competitors around the world that we don't want exposure to. And there's a lot of investment that we've determined that we need to make back here in the U.S., while also paying for all these retirees and rebuilding productive capacity here. So all this can take a lot of money, not to mention this green transition. So the U.S. has made that choice. I think it's like, we're going to spend a lot of money. We're not going to get ourselves out of that by creating some type of austerity or low inflation. So let's I don't want to say pretend that we want low inflation and then just trick people into having higher inflation. I don't think there's one person who's made this decision. I just think it's the body politic has looked at the configuration of economic challenges and opportunities that we have and said, all right, we're going to spend a lot of money. And if the cost of that is higher inflation and or a weaker dollar, which is more or less one and the same, then so be it. And so I don't think it's a problem. I think it's a choice.
Eric, I want to come back to our earlier conversation about the U.S. versus the European Union versus China. Let's talk a little bit more about where all of this is headed in the next few years, because obviously we've got a lot of talk now about expectations of growing geopolitical tension between the U.S. and China. How does that change the balance of global trade? How does that change potentially Europe's role in that balance? What are the various manifestations of how this can unfold?
So I think what's unfolding here is it's just fascinating. When I reflect back on my career, and I started in 89, I think it's really been characterized by it's ongoing deepening economic integration between all of these zones, competition between the U.S. and Europe always, and then the rise of China, particularly post 2000. And now, what appears to me is that we're really separating these three economic zones out in very material ways. And so when you look at last week, couple weeks ago, 2 weeks ago, Draghi released this EU competitiveness report, and it was utterly scathing, and to the point that he called for 800 billion euros, essentially fiscal stimulus, to try to reboost European competitiveness. That's 4.7% of GDP. It's just mind-boggling numbers. So I think that you're seeing real economic stagnation in Europe in an environment where the world's becoming less safe and less friendly amongst these different trading blocs. And so, China has, I think, economically hurt itself in all sorts of ways as it tries to deleverage somewhat. But it's been compounded by the U.S. being really aggressive as we have headed into this, it's really kind of a Cold War with technology and AI. And so, China is becoming increasingly isolated and economically less dynamic. Europe is stagnating markedly. And the U.S., I mentioned the U.S. for all its faults a little while ago. The U.S. is doing all sorts of things, including running massive budget deficits that are clearly unsustainable. But when you look at the economic dynamism of the U.S., if you just look at the top 25, just to use the equity market as a reflection of economic dynamism, if you look at the top 25 stocks in the world from a market cap perspective, they're all U.S. stocks, except for there's one Danish company. That's it. Europe has one. China has one. It's Tencent. The Saudis have Saudi Aramco. Does Japan have one? No, Taiwan has one. TSMC. So almost all of the top 25 companies in the world are U.S. companies at this stage. And so I think that the competitive dynamics between these three economic zones are going to define the global economy certainly for the next decade. Yeah, that's why I think it's so interesting. I'm curious how you look at that.
Well, Eric, I've been a secular inflationist for a long time, and I don't profess to know how to get the timing right, but I'm convinced that more inflation is coming. And in general, I think that the market is likely to be caught unprepared for that secular inflation as it eventually takes hold on the economy. I just have no idea how long it's going to take before that starts to happen. Let's move on now to energy markets. We've saw a huge sell-off in crude oil all the way down to low 65 handle last week. Then it seems like there was a big recovery. And then just on Monday, the day that we're speaking, we've seen a little bit of sell-off there. Where do you think energy markets are headed?
We don't trade a ton of energy. So I'm not a micro fundamentalist when it comes to energy markets. What I would say, there are interesting dynamics in energy right now, particularly electricity. But just stepping back, when I look at U.S. oil and energy production, I think as we think about how these different economic blocks are competing with one another, meaning the U.S. versus Europe versus China, energy is one of our clear strengths. And so U.S. energy production from 2016 to 2020 went from 9 million barrels a day to 12 million. And then under Biden, Biden actually continued Trump's policies and more or less in terms of accommodating greater energy production. And production in the U.S. went from 12 million to 13 million. Nat gas in the 2016 to 2020 period increased by 25% U.S. production and up another 15% under Biden. So this has given the U.S., economically speaking, a substantial advantage, and certainly versus Europe, given the issues that it has had with the Russia-Ukraine war. And China itself, has been rushing to create renewable energy sources to sustain its economy because it doesn't have very much fossil fuel. So I think we're seeing this. We're seeing again. We talked a little bit about U.S. equity markets reflecting a much more dynamic and robust economy relative to these other economic areas. And I think you can see the same thing manifest in energy supplies, energy markets. I suspect that the U.S. is going to kind of continue down that path. And that, I would say, just feeds into the interesting dynamic in electricity. So, this AI boom has created just a massive bid for electricity and for power. And I suspect that you saw, just recently, Microsoft has come out and appears to be funding a reopening of one of the 3 Mile Island reactors that was shuttered in 2019. So, that doesn't sound like picking the lowest hanging fruit. So I think as a reflection of kind of the demand for energy, these big companies are desperate for electricity. And when you're going and restarting nuclear reactors, it suggests to me that there's probably not a lot of electricity to go around. That just seems like a very expensive proposition. So I think there's going to be massive demand globally for energy, and the U.S. is going to continue to have a major advantage there. And Europe faces this massive headwind.
Yeah, the rumor is that deal with Microsoft was negotiated at $100 per megawatt hour of electrical consumption. That is a very expensive cost of electricity to be contracting long term. So if that's going to set a precedent, I think that there's lots of opportunity for people to build out more nuclear capacity in order to fulfill the demand that's going to exist in coming years.
I agree. All sorts of capacity. I think there's, and this is something that likely sustains the U.S. economy. There's just there's an awful lot of infrastructure that needs to be built out. Some of it has been subsidized to a degree by the Inflation Reduction Act. Some of it by just this corporate move to reshore production, bring it closer to home, and sustaining all of it will be relatively cheap energy here, but then converting that to electricity will create, need for a big build out here too.
Let's translate this macro outlook that we've been discussing to some more specific market outlooks. S&P 500 has been just continues to break to new all-time highs every week, it feels like. Should we expect that to continue through the rest of the election season?
It sure feels that way right now, doesn't it? I think the Fed 50 basis point rate cut at all-time highs in the equity market is really something to behold. So was
that a policy error?
I don't know. What I find so interesting and fun about markets right now is I think the level of uncertainty is just extraordinarily high, because if you just look at where we are with the economy and with the equity market and you close your eyes, if you told me that the promise of AI will manifest over the next 5 years, even if it's in a bumpy way, and the equity market is seeing above what might be some of the bumps along that path and is painting a picture of a world where productivity is significantly increased, which incidentally would allow U.S. budget deficits to decline to something more normal as opposed to something that's relatively obscene right now. If you told me that, I could get my head around the equity market being, as expensive as it is, being fairly reasonable. But if you told me that AI is overhyped and that some of the ways that it's going to be used are going to actually be detrimental to the economy via the political process, meaning that AI is used to just further divide the population and harm the country through the political process, and that the promise of AI is, even if it is wonderful, it's not going to be manifest for 5 or 10 years, and we're not going to have good visibility into that. You could look at the equity market right now as forming just a major, major top, and you could see this recent cut potentially being a policy error. But I don't know. But what I think we have to recognize, and from Powell's press conference, I think Powell doesn't know. None of these guys know. And we've left the world where central banks have successfully kind of pretended that they have the levers and the dials and know what's going on in the economy and kind of can move it at their whim. I think we kind of left that world post-COVID. The mistakes that central banks have made have been magnificent, really. And what they're hoping to do right now is get us back into a place where we think, okay, they know what's happening. they've got this under control and they're going to land this economy softly, whatever that means. But I think that the reality is that they don't know what the future holds. This has been such a unique cycle, and this new arrival of AI makes the future look so uncertain. So I wouldn't say that it's a policy. I just think we're going to see. I think that these guys are feeling their way across the riverbed. They can't really see what they're stepping on, and the potential for a big mistake is very clearly there. But we'll have to see how it manifests. The stock market's saying right now that it's fine.
Let's talk about commodities next. Are we in a new commodity super cycle, and what's your outlook for commodities and the dollar?
I suspect, Eric, that we're getting closer to some type of Chinese economic stimulus, just because the economic and the market performance there is just so poor. Kind of like with the COVID lockdowns, you didn't really understand, why Xi was so strict, and it felt like he wasn't going to change his mind. And then all of a sudden, over, a very short number of days, he completely changed policy. I think we're probably getting closer to some type of Chinese stimulus. I don't think it'll be a commodity-led stimulus, not a big building boom. It'll be something else. But I think commodities have priced in a very, very weak China at this stage. So I think there's more upside than downside to commodities in here. It could be part of the dollar story as well. So I do think that the U.S., I think the Fed is going to start lowering rates, in a material way. Obviously, what the Fed thinks they're going to do and what the market thinks the Fed is going to do are two different things. But I think we're going to start seeing material rate cuts out of the U.S. here. And, that should overall weigh on the dollar. I think that the big dollar move, though, is not going to be just because of rate cuts. The big down move in the dollar, which I do think will come, that's going to be led by a concern about debt sustainability in the U.S. And so, you asked about policy error. If you were to see the Fed cutting rates persistently, and we were to see the market fall out of love with this AI story, and people worried that, oh my God, we're not going to get a great productivity boom out of AI. There was a lot of hype and a lot of promise, but light on the delivery. If we were to see that type of environment, I think that's when you could start worrying about U.S. stagnation, and you could get people leaving the dollar in a material way. That's where you get a big dollar decline. That's where you get the kind of the stagnation or stagflation type economic environment. That's the real downside for the market right now. But I think it would largely be led by a rate hike, equity markets rolling over, economy being particularly weak, and concerns that the deficit in that environment is just going to explode. If we're 7% right now and we actually have a material recession, and you see that number go up to 12% or something with no real hope for it to come back down, that's when the dollar gets smoked. We're clearly not there, but that's the type of setup I would see for a weak dollar. And I think that would be a big trade. So that's the thing to keep on your radar.
Okay, if we're keeping that on the radar, are we keeping it on the radar for a long precious metals trade or for some other kind of trade?
I think precious metals would do incredibly well there. And it's interesting that they're doing as well as they are right now, even with an economy that's doing pretty well. I think digital assets, certainly Bitcoin and Ethereum, do extremely well there. Bitcoin's up, 130, 140% over the last 12 months. So these markets, these forward-looking inflation markets like Bitcoin and gold are suggesting that there is inflation around the corner. I think that there is as well. I think that we're right at the tail end of the first wave of this inflationary cycle. So, the inflationary cycle, we were calling for it in kind of 2018, 2019, and then 2020 hit. And ultimately, we all know that it really took off then. And when you look historically at inflation, it moves in waves, and inflation itself tends to be very volatile. So we had the big up. We've now had a significant normalization, and now we have a rate cut cycle with running huge deficits. So I think that we're in for inflation stabilizes in here and starts heading higher for a bunch of the reasons that we talked about with supply constraints and investment demand and infrastructure build out, et cetera. But if you compound that with a weak dollar, that's when you see really explosive moves in metals and in digital assets as well.
Well, Eric, I can't thank you enough for another terrific interview. Before I let you go, I want to give our listeners a little bit of an update because I don't think that Coinbase had acquired your digital arm yet last time we spoke. Give us a little bit of perspective on what's going on with your company. You've changed your role a little bit. What do people need to know, and how can people follow your work?
So, as you probably recall, we entered the digital markets in November 2020 with what at the time was the largest institutional allocation to the space. We, roughly speaking, tripled that investment, returned that capital, but in the process built out a digital asset manager called One River Digital Asset Management, and continued to build that company. Coinbase acquired that about a year and a half ago in its entirety. And I thankfully have been able to remain the CEO and CIO of One River, where I have two terrific deputy CIOs, and also I'm the CIO of Coinbase Asset Management now, where I also have just a fantastic deputy CIO. So I straddle both firms, which as a macro investor is a wonderful place to be, because I do think that crypto and traditional macro are converging around this big currency trade that we probably have ahead. But it's also it's a new technology play as well. So we were talking about CBDCs and private sector stablecoin and monetary policy and macro, and all these things are really connected. So it's been a fascinating two seats to be in, I should say.
Patrick Ceresna and I will be back as MacroVoices continues right after this.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great interview with Eric Peters. Nick Galarnik is away this week, so let's get to that post-game chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Eric Peters' picture saying looking for the downloads. Now, Eric, let's cover crude oil, starting with the EIA inventory data.
Crude oil printed a drawdown of 4.5 million barrels this week. Cushing, Oklahoma printed a very small 116,000 barrel build. That was a nice little bit of help, but not nearly enough to solve the problem there. They're still just barely above their operational minimums. And we also have big drawdowns on the finished products, with gasoline drawing down 1.5 million barrels, distillates drawing down 2.2 million barrels, for a net petroleum products drawdown of 8.2 million barrels. U.S. production ticked down 100,000 barrels to 13.2 million barrels. Oil rebounded nicely, about $7, more than $7 now, off its September 9th lows, but the rally is now struggling. As of Wednesday's close, we're still holding just barely above that 69.09 13-day moving average. That's the critical short-term support level. If that breaks, I think we could see significantly lower numbers from here.
Yeah, Eric, so many commodities have turned up on the China story, but crude oil is not one of them. The pattern of lower highs, lower lows, primary downtrend channel remains intact. The entire rally over the last 2 weeks was simply a retest of the 50-day moving average, and so far we've rejected there. Now, overall, I think we're actually very close to the bottom end range of crude oil. I don't think there's a huge downside risk, but that doesn't make it immediately bullish. It's entirely plausible that we stay in a range-bound area down here, even past the elections, and therefore, even if we dip temporarily down to $65, it could return right back to 72 and then just consolidate sideways. I think it's more of a trader's market on the short term. Be looking where the bottoms finally establish themselves for a potential new bull signal, but right now that downtrend is quite intact. Let's move on to equities. The S&P continues to rip. What are your thoughts here?
Well, Patrick, you could make either of a couple of arguments here. One would be to say this market clearly is overbought on a technical basis. You can also make the fundamental argument that with a lot of people eyeing a recession, there's lots of reasons to think that equities are overvalued here. The counter argument, frankly, is the Fed is political, and they've decided to juice this market through the election, and that's what they're going to do. And it's probably almost certain to continue through the election. Sorry to be cynical, folks, but I'm going to go with the latter. I think the Fed is political, and I think they are goosing the economy to support the election, and I think it is going to continue.
Yeah, the bull market has been relentless. The pattern of higher highs, higher lows, the trend continues to be quite intact. The only thing here is that now many different measured moves are targeting these areas near 5,900 on the upside. So while the trend is higher, the accumulation is very clear. The flows continue to show that pattern of moving higher. But on the short term, I think we're approaching where the upper boundary of this move will be. Now, the bigger question is, will when we put in a short-term top, it simply be well defended and bought on dip? Or will we see a deeper pullback that, let's say, violates a 50-day moving average? On the short term, at this stage, I think we may even continue this pattern right up until the jobs numbers. So it's entirely possible when we're recording next week that the market's still up in these elevated areas. The bigger question is something like the jobs numbers next week offer a catalyst for some sort of profit taking. All right, Eric, let's talk the dollar.
We're still consolidating between 100 and 102. So far, every test of 100 has been firmly rejected. I expect that round number support at 100 will eventually fail. When it does, I think there could be an acceleration to the downside. But as long as that 100 round number level is holding, we're going to continue this sideways consolidation.
Yeah, Eric, it's interesting that the US dollar remains in its primary downtrend. It continues to be distributed, but there are some key inflection points here. The euro is testing a very critical 112 resistance level. We're going to find out whether or not that currency can beat that level. I think it's going to be critical. And at the same time, it's clear that the US dollar yen has established at least a short-term trading low. And the bigger question is this a bigger retracement where we could temporarily see the US dollar yen trade back to 150 the moves in some things like the pound sterling are now getting very robust and overextended. So it's entirely possible that this is going to be, at least on the interim, where the dollar may settle down and establish lows. The bigger question, does that then turn around into a US dollar bull rally? And that has not shown any sign yet at this stage. Let's just see where the short-term support lines establish themselves. I think it would take a break above that 102 level that you just mentioned that would start to signal to the bulls that maybe there are bigger reversals underway, but that there's no sign of that yet. All right, let's talk precious metals. Let's start with gold here.
Patrick, I think this week's trading action marks a very important new development in this gold bull market. Yeah, we're up this week, but we're not just up. We broke through several important technical levels, and we broke through those levels with gusto, barely even pausing before breaking through each of several different levels. We're back to extreme overbought on the slow stochastics, but frankly, just as market crashes begin from an oversold, not an overbought condition, the really beautiful melt-up in gold prices that I think might be coming would begin from overbought technicals as opposed to oversold technicals, and that's exactly where we are right now. Bigger picture-wise, though, we do need to take stock of how far along we are in this bull market. The target of that long-term, decade-long cup and handle pattern is 27.24. That's the pattern that goes back to the blow-off top in 2011. That was targeting 27.24. We didn't think we'd get to it this year. We're almost there already. So we need to start to think twice about how far along we are in this market, but I don't think it's anywhere close to over. It does make sense, though, to remind ourselves that we've come a long way to the upside, so there's plenty of room for significant downside corrections without disrupting the overall bull trend.
Yeah, Eric, that 2,700 target was something that we've talked about numerous times on this show, and here we are, and so gold is approaches now. There are some bigger weekly measured moves that are to 28 and 2,900, so I don't want to already be fading this gold rally just yet, but it does feel, at least on the short term, that this has played its course and is due at some point just to pause and consolidate. I actually remain super bullish gold in the bigger picture. The one thing we're just technically trying to observe is the ebbs and flows of some of these overextended markets and where short-term buy on dip opportunities emerge. At this stage, I don't see a lot of asymmetry in putting on brand new gold trades until there is a dip, and we're watching closely what we're up along here where the gold market runs out of a little momentum. But it will be interesting because I have on page 6 the chart on silver, and silver is just attempting to break out to its new year high up at $32 and change. It could be possible that there's still one more bull impulse here where gold, let's say, puts another $100+ an ounce on the upside, while silver has some sort of catch-up rip where if it breaks to these fresh new highs, that we have a $2 or even $3-4 advance in silver up to the $34-35 plus dollar areas. Will be certainly a way that on the short term that these precious metals can play out. Let's watch whether silver can make that break. I wanted to just on page 7 highlight the copper chart, and we've been generally observing the distribution cycle that copper has been in relentlessly for the last 3 months. We were watching at what it was doing along that 50-day moving average several weeks ago, but really this China monetary bazooka storyline really flipped the script as many of these commodities that have been beaten down with the backdrop of a weak China suddenly are getting a little bit of tailwind. This breakout here on copper has actually beat some key fib zones and is now spending a solid time consolidating above its 50-day moving average. If we see this price level being well defended and we see old dips being bought and it stays above 4.25 on pullbacks, this could be a very key turn point in commodities, something that would be welcome from the battered commodity bulls. Will we see this turn? At this stage, these are the key kind of turn points that can develop into new trends. So you can't ignore these kind of turn points, especially when they're given a catalyst that way. On page 8, I just have the natural gas chart. It's interesting that while we see both gasoline and oil under continued pressure, natural gas, at least from a seasonality perspective, is really starting to turn up as we're now going into the fourth quarter, where not only do we see nat gas roll up the term structure to winter gas, but we're certainly now seeing some of the even front month contracts actually getting bid. So that right now nat gas turning up. Will we see a move of the similar magnitude as we saw May and June, especially with a number of hurricanes and other things forming that could create supply issues? Nonetheless, nat gas definitely turning up. A retesting of its January and June highs seems like a very reasonable short-term target. Let's move on and talk about uranium here. What's your thoughts?
Well, I just love how civilized this market is. Several people had predicted that the WNA conference in London would be the pivot moment, the catalyst event to turn this market around. And practically as if it was scripted, the bottom in the uranium market appears to have occurred at the last day of the conference. That was September 6th, and has been going straight up on improving news flow ever since. So hopefully the bottom is finally in for this market, but of course anything is still possible. The big news this week was Friday's announcement of Microsoft signing a 20-year contract to buy energy from the restart of 3 Mile Island's reactor number 2. That's of course the one, not the one that melted down in 1979, but the one right next door to it, which was just shut down in 2019. So they're going to restart that reactor for Microsoft. Then there was more bullish news on Monday of this week. Our friends at ENEC, that's the Emirates Nuclear Energy Company, hosted a big shindig in New York City, basically organizing bankers to support the triple nuclear initiative. So now we not only have 25 nations around the world having pledged to triple nuclear energy by 2050, but we have all of the major banks signing on to say, yes, they're ready to finance the building out of that tripling of nuclear energy by 2050. So lots and lots of bullish signs. So far, though, the spot price of uranium has yet to move. So let's continue to watch this market. If we don't see some action on the price of uranium, I could easily see prices dipping back down despite all of the bullish news. So let's watch for an actual move on the price of uranium. When that happens, I'll really be confident that the bull move is on.
You know, when we talk about hopefully the bottom is in, what is encouraging is that both August and September saw the lows establishing themselves, where basically it was trading in its primary downtrend, staying below its moving averages, but it stopped going down. A lot of those sideways consolidations are quiet accumulation areas, forming things like double bottoms and other things that eventually turn up. Obviously, this really nice kickstart that we saw not only in the uranium but also in uranium equities has now gotten many of these above their moving averages, breaking multiple highs that they established in August and September. So these types of things are often there when potential new bull trends are underway. And when you stop and reflect on after that enormous 2023 bull run, we went through an 8-month consolidation in this, which kind of took out all of the bullish excess that was built in the last impulse. There is plenty of pent-up energy that if this story turns around, that we really get things going on the upside. Eric, I just want to touch on two more charts. On page 10, I have the Bloomberg Commodity Index. And I did this on a weekly chart so we can really zoom out and see what's happening here. What we had was an enormous bull run from 2020 out to 2022. And now we've gone through a 2-year consolidation in the broad commodity basket. We saw that in the grains. We saw that in all sorts of metals and iron ore and other things like this. And suddenly we have this slowly trying to tick up above its 50-week moving average. Now, we have not officially seen breaks to higher highs, higher lows, consolidations that are showing a new bull trend is underway. But this is going to be very interesting to see whether or not this is a turn point in the bigger picture. As you can see, it's very, very early. We don't even know if it's the first inning of a bull run. Overall, I do believe that we are in a secular commodity bull market. So if this really starts to show signs of life, we can't ignore it. Finally, on page 11, I have the 10-year U.S. Treasury yield. And what we really have seen was that the FOMC was a buy rumor, sell news on bonds. The yields did come off of those lows near 360. At this moment, I think that the bond market is going to take a moment and a pause to really size things up with the amount of rate cuts that are being priced in for next year. If, in fact, we do have a soft landing, which is not my favorite scenario, but possible, then the market may just be pricing in too many cuts, and all of the bonds, whether 10 years, 2 years, all of them might just mean revert and give some of it back to come back to a more stable level. I'm at this moment think that there's room for yields to retest even 4% on the interim while we see where the next kind of major economic data points are turning the economy.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
On this week's Research Roundup, you're going to find the transcript for today's interview and the chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this and so much more in this week's Research Roundup.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.